This episode is brought to you by Plaid. Plaid helps lenders approve more creditworthy borrowers without taking on more risk, combining real-time cash flow data with behavioral insights. It's a fast, familiar experience people trust and that actually converts. Learn more at plaid.com. Hello, and welcome back to the Fintech Takes podcast, the first Fintech Takes podcast of 2026. And of course, we needed to start with Fintech Recap, recorded with our friend and the publisher of Fintech Business Weekly, Jason Mikula. For this episode, Jason and I did something a little different than what we normally do. Instead of recapping the last month or so of fintech news, we recapped all of 2025. We picked out 5 big themes from the year and talked about things that we noticed in 2025, things that we think shaped the banking and fintech industry in 2025, which then fed into some predictions we have for 2026. The trends we noticed and the predictions we made span a wide variety of topics, from private credit and lending and credit risk to crypto and stable coins to companies that went public in 2025 and companies that may choose to stay private in 2026. We, of course, talk a lot about the regulatory environment, which I think is one of the biggest things that changed between 2024 and 2025, and something that seems likely to shape 2026 in pretty profound ways. I even got in a good rant on gambling and prediction markets, which inspired Jason to break his normal rule of not using curse words on the podcast, which was a delight to experience. All in all, a great episode, a longer episode than normal, and one that I hope kicks off 2026 the right way. So without further ado, here is Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, well, I shouldn't say Happy New Year's because we're recording this still in 2025, but by the time folks listen, it will be 2026. Jason, thank you as always for coming back. How are you, sir?
I am doing well. I'm enjoying mostly sunny Arizona at the time we're recording this, although by the time it comes out, I will be back home in the cold, gray, damp, firework-obsessed Netherlands. Although I am looking forward to getting back home. It's been a very nice break. As I told you before we started, deleted Twitter from my phone. My mental health is orders of magnitude better, and got a chance to, review and prepare for this podcast. So looking forward to chatting about 2025 and thinking about 2026.
Yeah, I love it. In preparing for this podcast, I actually went back through and I didn't listen to all of our podcasts from 2025, but I sort of skimmed the episode notes from all of our podcasts, and it was an eventful year. So the plan for our podcast is, I think, to spend most of our time, as is the name, recapping what happened in 2025, trying maybe a little more thematically to recap what happened in 2025, and then wrap up with some maybe predictions based on an understanding of what happened the previous year, what we think might happen in 2026. Jason, I think I can speak for you on this by saying that neither one of us put a whole lot of stock in predictions or our ability to predict the future, but hopefully after talking about what has happened over the last 12 months, we'll at least have the seeds of maybe some good predictions for 2026. And then perhaps we can wrap up with a thing that we can't let go of, especially since you now have added Twitter back onto your phone, maybe. So you've plugged yourself back into this insane ecosystem that we work in. And I'm sure there's something that has infuriated you. Does that sound like a plan?
That sounds like a perfect plan.
All right. So we have come up with, 6 themes from 2025 that I want to hit with you, Jason. I will go first with our first theme, which I have, in the spirit of a certain Netflix show returning, called Regulation in the Upside Down. Okay. So broadly speaking, my first observation as a theme from 2025, and I feel like this is the right place to start, is that we got a radically different regulatory landscape in 2025 than we had the previous 4 years. Obviously, that makes sense given that we knew there was a change in political control of the White House. I think even going into 2025, we expected to see some pretty significant regulatory shifts. And yet, Mr. Mikula, I feel like I still was kind of unprepared or underprepared for just how wacky the regulatory landscape became in 2025. And I
think that's a very polite way of putting it. But yeah, please continue.
I mean, like, I was like, I tried to prepare. Obviously, we had done the whole Donald Trump being president thing before. So like, I felt like I was somewhat prepared. And yet, for reasons I'm sure we'll talk about, it ended up being crazier than I thought it would be. So let me briefly recap a couple of changes that happened on the regulatory side in 2025. And you just jump in as I go through these with any little observations or things you've noted. The first one, obviously, we'll sort of start at the top and work our way down, was a change in control at the Treasury Department. So obviously, Bessent became Secretary of the Treasury. Jonathan McKernan, who was formerly a board member at the FDIC and who briefly had been nominated to lead the CFPB before wisely pulling away from that, became one of the top deputies under Bessent at Treasury. Jason, my observation starting at the Treasury Department is that while technically Treasury has sort of sat over almost all of the sort of bank regulatory apparatus for a long time, it seems from just the sort of breadcrumbs I've been picking up that Bessent has been maybe more focused than some of his predecessors on exercising a great deal of control over what's happening in the bank regulatory sphere. Have you noticed this?
Yeah, absolutely. I mean, I was trying to think back to, some of the hot topics or, themes and areas specific to bank regulation in the Biden administration. And it's like, to be honest, I don't really remember thinking about Janet Yellen as like a force or a player in that sphere, right?
She didn't seem to come up at all, really. Yeah.
Like Mike Sue was at OCC. It operated as it, I believe, is intended to operate as like an independent regulatory agency. And obviously there was a ton of stuff happening at Treasury that was important, but like it felt very sort of separate. I mean, I think the sort of broader theme of this administration is this very strong centralization of power in, really a small cast of characters, who are around Trump, including Bessent. So on the one hand, I suppose that's sort of consistent with what's happening in other spheres of politics and regulation, but it does seem to be a fairly sharp break with sort of how these agencies have operated, in the past.
Yeah, that's been my observation too. I mean, you and I both saw McKernan speak at the AFC Policy Summit earlier, I guess, this year in DC, and those comments or those appearances always are sort of very calculated and have sort of their own specific purpose behind them. But I did definitely note like very strong, and obviously it's in the interest of McKernan and the officials at Treasury to sort of position it this way, but like, he very much framed what they were doing as like, we are setting the priorities and we are coordinating across all of the agencies to sort of wrangle and push forward these priorities. And so I suppose to a degree, everyone who works in those roles at Treasury over the years has sort of thought of themselves this way, but I do get the sense that they are trying to play more of that centralized role in a way that, contributes to one of the themes we're going to talk about in a little bit, which is this sort of like weakening of sort of agency independence, which we've seen, I guess, across the board in the second Trump administration. All right, second change, obviously, and we could spend the full podcast talking about this, but we won't, is Rohit Chopra being fired early in 2025 and being replaced, I guess, supposedly temporarily, but now it seems maybe not so much, by Russell Vogt, who has done a lot of stuff at the CFPB. Too much to really talk about, I suppose.
I I mean, I think the main thing he's done is gutted it and stopped it from functioning, more or less. I mean, I'll admit I have not followed every twist and turn of. I think there's multiple pieces of active litigation. The main one being the NTEU, which is the union that represents CFPB employees. I want to say it's like National Treasury Employee Union versus CFPB. That case is ongoing, but then we've seen other sort of gambits to try to basically starve or functionally, gut the CFPB, specifically deciding, I think it was the Office of Legal Counsel at the DOJ, issuing an opinion saying because the Fed does not have quote unquote combined earnings, there's no funding for the CFPB to draw, which the Fed has not had combined earnings for quite some time. Although I believe either now it does or in the near future it is expected to have earnings. So you have kind of like a lot of moving pieces with, the intent. And I mean, I sadly actually read Project 2025, like the relevant portions as they related to the financial regulators. And like this was always very explicitly, part of the plan, I'll say Republicans sort of broadly have always sort of painted the CFPB as a partisan agency going back to its creation in the wake of the 2008 financial crisis. Elizabeth Warren is their favorite boogeyman, et cetera, et cetera. That said, I think there are and there will continue to be a host of unintended consequences, including some that the industry, the banking industry itself, does not necessarily like. Specifically, that you now have this very weird situation where if you're a financial institution below 10 billion in assets, you are still being supervised by your prudential regulator for the relevant consumer protection laws. Mm-hmm. Whereas for all intents and purposes, if you're a larger institution over that 10 billion threshold that the CFPB has jurisdiction over, like it's kind of open season, except asterisks. And I know we're going to talk about this more later, but you still have state attorneys general. You also still have the FTC, which FTC has jurisdiction over UDAP with 1A. So there are still, regulators that can enforce some of these laws and regulations that ostensibly the CFPB should be enforcing. So it's going to be interesting to see sort of how this continues to develop in 2026.
Yeah, I mean, it's fascinating because the CFPB, I think, somewhat by design, has the most sort of like broad mandate. And so, you see, I think, the biggest swings depending on what the objective of the person in charge of the CFPB has been. And, until recently, I think we were blessed, although maybe we didn't appreciate it, with people who ran the CFPB from both parties, quite frankly, who had sort of a somewhat moderate approach to like, we're going to generally take the mandate of the CFPB seriously. We're going to sort of do what we are required to do. And it's not until recently, I would say, under the Biden administration and now under the second Trump administration, where we've seen more sort of extreme interpretations of what the CFPB is supposed to be doing or not doing. And it does sort of illustrate, I guess, almost from a statutory perspective, like just how broad the potential mandate, or I guess narrow the potential mandate of the CFPB has been, subject obviously to lots of legal challenges. I mean, Russ Vought is taking it in an extreme direction that, again, looking back on the end of 2024 and going into 2025, I did not anticipate anything even remotely close to this. Obviously, we knew the CFPB was going to be a target, but this has gone a little further than I expected. Rounding out, of course, our changes in agency leadership, we also have Jonathan Gould replacing Mike Hsu at the OCC. We have Travis Hill replacing Marty Grunberg at the FDIC. As you pointed out when we were prepping for this, the FDIC board, which is supposed to have 5 members, currently only has Travis Hill, Jonathan Gould, and Russell Vogt. There's also supposed to be 2 minority party members, which there were under the Biden administration. And those 2 slots are vacant at the moment. And just based on generally what's happening with the Trump administration, I wouldn't hold my breath that those vacancies will be filled at any point. We also had Michelle Bowman replaced Michael Barr at the Fed as sort of the head of bank supervision at the Federal Reserve. We also obviously know that President Trump would very much like to get rid of Jerome Powell, although literally no one, including the conservative members of the Supreme Court, seem to think that's a good idea. And then finally, Jason, I pay very little attention to the National Credit Union Administration, but have you looked at this agency? It seems to be
I'm embarrassed to admit, I when I think about like the bank regulators, I often just forget that exists altogether.
I do too.
I mean, I think we're probably both aware of it in the current context of, again, what was it, 1 or 2 Democratic appointed board members being fired, and like ongoing lawsuit about whether or not those terminations were legal. And off the top of my head, I'm not sure where that case stands. I want to say at some point the woman was like reappointed, but then maybe not. Like, do you know where the status is on that?
Yeah. So basically, the short version is that actually, the 2 Democratic members of the NCUA board were both fired. One of them actually, ironically, was appointed by President Trump in 2019, and then one was appointed by Biden. They were both fired. Supposedly, the NCUA is supposed to be an independent agency where, except for cause, you can't fire board members. So again, sort of part of a larger theme under the current administration. My understanding is their cases are somewhat in limbo because even though some lower courts have ruled in their favor, the case has essentially been paused until the Supreme Court weighs in on sort of agency independence, I think on a related case. And so we're sort of waiting for the Supreme Court. And of course, the Supreme Court is in a tough position because, again, as I referenced before, they, along with everyone else in the civilized world, doesn't want President Trump to be able to fire the Jerome Powell, the head of the Fed. But if you do that, then are you also allowed to fire other independent agency heads? So there's sort of a bit of a legal conundrum there that I think the Supreme Court is wrestling with. Also, interestingly, Kyle Hoptman, who is the chairman of the NCUA and the only board member right now, his term actually expired in August of this year. And so he apparently can serve in a holdover capacity until his replacement is nominated, which I don't think is going to happen. But also the NCUA, without the 2 other board members, they don't have a quorum. And so legally, they're not actually able to regulate almost anything at all. It's a mess, basically, is the long and the short of it.
I can't believe you left off this list in our outline, our favorite agency, the FHFA, and our favorite regulator, Bill Pulte. But we will not. I don't think we need to go there because we don't have time. No.
Yeah, dissecting his Twitter account would take more time than we have. But yes, suffice it to say, he was a spicy addition to the bank regulatory environment. Maybe the starring character of 2025. All right, so Jason, I have made a list of what I think are, from my perspective, the kind of key priorities that have been expressed by this new crop of regulators. And when I say expressed, sometimes I mean in very explicit terms, and sometimes I mean in very sort of implicit, just have to read between the lines type of terms. I'm just going to list these out, and then you tell me where you want to focus. You ready?
Ready.
All right. So first, is what I'm calling do less with less, which is to say, lighten the supervisory load on banks, what some regulators call tailoring of regulations to the different size banks, while cutting back on the amount of staff at the regulatory agencies, which is something that we've seen across the board, although obviously the CFPB is the most extreme example of that. Number 2, what I'm calling DEI out and debanking in. So get rid of anything that feels vaguely DEI-y, including fair lending enforcement, and instead focus on debanking and eliminating debanking to the extent that it ever actually happened. Number 3, embrace innovation. especially as it relates to crypto and to AI. Although I also think there's been a little bit of an undercurrent of interest from regulators in modernizing some of the approach to supervision around banking as a service, your favorite topic. Make bank charters accessible, or as you put it a little later in the outline, make de novos great again, which I think we've seen across the board, both with national bank charters for de novo national banks, as well as national trust bank charters, which have come into fashion. And then finally, and this is less of a reflection of the national federal regulators, although somewhat in response to them, but increasing activity from all of the state attorney generals, particularly as it relates to consumer protection, and particularly as it relates to blue states like New York, California, Illinois. Mr. Mikula, that was a lot. Any of those areas jump out to you?
So I want to start with what you framed as do less with less. I mean, I'll admit I do not read like every single set of remarks that come out from the various regulators, often because they tend to be repetitive and frankly somewhat boring.
Yeah.
But I will say, like, one of the recurring themes, particularly from Michelle Bauman, but I think you've seen this from Gould and others as well, is refocusing supervision more explicitly on what they're describing as financial risks, as opposed to this sort of like broader array of types of risks. And we saw, some of this commentary in the wake of the collapse of SVB and the so-called regional banking crisis, where, I think there was kind of a critique of the regulatory establishment broadly, that it had become very sort of process and checklist driven, and sort of maybe lost focus on what are the core specific risks that could, cause or lead to a bank failure. So when I hear that, I'm not like immediately unsympathetic that perhaps there does need to be, perhaps it's overdue to have a bit of recalibration of like, what is the purpose of bank supervision and how does that actually unfold on the ground when you have, bank examiners, working with and going in to supervise a bank. So I think like conceptually in theory, that sounds reasonable. However, and there is a however here, there are other kinds of risks and there are other, at least historically, other roles or other goals of banking supervision. I mean, I think no one who listens to our conversations will be surprised that I pay a lot of attention to financial crime risks, so sort of like BSA, AML generally. Not to say that there are not a lot of issues and problems with how that as a like apparatus is instantiated and operationalized. Gobs and gobs of resources from the private sector and from regulators like go into this BSA AML regime. And, overwhelmingly, if you look at any of the sort of statistics, it's like a fraction of a percent of like financial crime is actually like detected and stopped or prosecuted. But what I'm, particularly with some of the things we've seen with, Trump himself and his family, as far as like the cryptocurrency projects they're involved in and stablecoin, et cetera, it feels like there is a very real possibility that intentionally or not, this becomes sort of a green light for, go do whatever you want, as long as the sort of fundamental economics, the fundamental financial position of the bank, is sound or appears to be sound. And, there are second and third order consequences for the financial system and for society in taking that approach.
I think that's right. I mean, it's interesting because, and it kind of ties to the debanking stuff a little bit, but like there has been this real strong focus on the part of all the regulators that are in charge of supervision, particularly from a safety and soundness perspective of like, let's just focus on financial risks. Let's take out reputation risk. Let's take out anything sort of judgmental from a regulatory perspective and just look at financial risk. And at the same time, another theme that I think I could have thrown in here because it's something that is sort of true. Regulators always say it across the board, but I think it's used as an excuse for different types of actions, depending on what your actual goal is we need to make community banks great again, right? And community bank executives celebrated Mickey Bowman getting the job after Michael Barr stepped down. But I think that one of the challenges there is that when we talk about like regulatory supervision and tailoring of regulations, a lot of times the example that's used is, like, look at this tiny little community bank that has to go through all of this like compliance work. We need to make their lives better. And that is often like the case study that's held up for regulatory tailoring. But a lot of the actual tailoring and changes that happen between like the top 10 banks and then the next 25 banks, right? And like we actually saw the impact of tailoring, I think, potentially gone wrong with the failure of SVB, right? Because SVB in the first Trump administration sort of got scoped out of some of the most stringent regulation reserved for the very largest banks. And then we saw just how big and potentially problematic SVB became when it failed. And, supervisors were unable to catch some of the warning signs in advance of SVB's failure. So I struggle a bit with this idea that I'm with you. These things sound great in theory, and I do think there are plenty of community banks that are inhibited from being as successful as they could be because they're just sort of like subject to way too much regulation for their size. But you have to be very careful when you're tailoring because there are risks hiding at different size institutions. And, Kia and I have talked about this a lot on Bank Nerd Corner over the years. Like where you choose to draw those lines sometimes is arbitrary, but sometimes it also allows for flexibility in terms of being able to look at the risks those institutions pose. And yes, sometimes regulators' job is to have more of a, qualitative opinion about the bank's quality than a quantitative opinion, right? Like sometimes these things don't show up in numbers until it's too late. So even though I can be very sympathetic to, people feeling like under the Biden administration, regulators were too checklist driven and were too sort of like stubborn or rigid in the way that they evaluated banks, or in some cases too sort of like mushy and qualitative and just, we don't like the smell of this. I think you can go too far back the other way. And I guess that's something I worry about.
This episode is brought to you by Plaid. Approving more borrowers shouldn't mean blindly taking on more risk or adding more friction. The problem is that traditional credit data is limited, and cash flow data alone doesn't always tell the whole story. Plaid helps lenders see the full picture by combining real-time cash flow data with insights from the financial tools people already use every day. Those signals come back in seconds through a low-friction experience trusted by about half of U.S. adults. That means you can approve borrowers who are stronger than their credit file suggests, spot risk earlier, and grow without loosening your standards. Visit plaid.com to learn more.
Well, and somehow we've made it 25 minutes into this conversation, and I haven't said the word synapse. I think there's also an argument that there are things that do not, on the surface, are not explicitly financial risks, the way that asset liability management or asset quality, liquidity, interest rate risk, et cetera. There are, perhaps operational risk, technology risk, third-party risk, cyber risk, these things that are maybe not categorically defined as financial risks, that if something goes wrong, they can become financial risks.
And they absolutely can. That's right.
I think that it is perhaps very narrow or short-sighted to say, we're only going to look at these things that are sort of explicitly defined as a financial risk and take a much lighter view or lighter touch on some of these other categories that maybe we do not sort of deem a first-order financial risk.
Yeah, I think that's right. I also think it's just interesting, kind of, again, I don't want to drag us into debanking because very little good comes out of that. But I will say one thing that's been really interesting to me is the sort of antagonism, seemingly, that a lot of the bank regulators under this administration have towards the very largest banks. it was interesting to me in the debanking report. I use the word report very loosely because it wasn't much of a report that the OCC published on its preliminary findings looking into debanking, where they said, like, this is only a problem caused by the largest banks, and community banks don't do this. And that just seemed like much more of a, we wanted to sort of end up with that answer, so that's where we started, than an actual like bottoms up. We looked across all the banks we regulate and looked for evidence of debanking. And so I do find like somewhat different maybe than your classic Republican administration, where, you know, banks are sort of getting everything they want and the biggest banks get the most of whatever they want. I think under this second Trump administration, generally speaking, private businesses are getting kind of what they want and they're getting deregulation. But I don't think the biggest banks are always necessarily getting everything they want. And that probably relates to feelings that people in the Trump administration have about specific large banks. Chase has gotten itself dragged into a lot of that by name, unfortunately for them. So I do find that dynamic a little different than your classic either Trump 1.0 or previous Republican administrations.
Well, this, and I mean, I think it's showing up also in the sort of like de novo stuff, and as you mentioned, you know, AI and innovation in the banking system. This administration, I mean, even compared to Trump 1.0, you have a very different set of stakeholders who are influencing this policy making. I mean, you look at somebody like, I still laugh every time I think about that. Mark Andreesen interview on Joe Rogan because it was just so unhinged.
Oh, I know.
But I mean, the sort of like Silicon Valley VC, you know, David Sachs as the AI czar, like you have a very different cast of characters with different, you know, both sort of different policy priorities, but also just a different sort of way of viewing the world and viewing government. And I think that is flowing through to some of what we're seeing, you know, come from the regulators.
I couldn't agree more, and that's actually a perfect segue to our second theme. Do you want to lead us off on this one?
Yeah, I mean, I think it's fair to say 2025 was the breakout year for stablecoins. Obviously, you know, stablecoins were not specifically a new thing in 2025. Mm-hmm. I mean, in fact, a type of stablecoin was really the genesis of the crypto crisis and crypto winter in 2022. However, that was quite a different thing because it was a so-called algorithmic stablecoin. Do not need to go back on that Terra Luna meltdown bandwagon. But really, like stablecoins, as far as what appear to be a, you know, practical, meaningful at-scale use case for crypto, for a type of crypto or for blockchain, really like exploded in you know, in public consciousness and in the industry in 2025. I mean, when you hit the status of having multiple conferences about specifically that topic, you know you've made it.
Or coming up at Thanksgiving, which it did come up at my Thanksgiving a little bit.
Who asked about stablecoins and what did they ask you?
I had an uncle and a cousin both ask me about stablecoins. They kind of asked me like what they are or what you use them for. And I had an okay answer to the first question. I didn't have a great answer to the second question because they live in the United States and have bank accounts. And like there wasn't really a lot of like obvious use cases for them, but it had clearly like penetrated their consciousness as a non-bank fintech nerd, which I always take as a sign of like starting to break through. It reminded me a little bit of 2021 when we had like all the crypto commercials, you know, at the Super Bowl. And it was like really like, do I need to buy crypto? Is crypto something I need to like know about? This was like a flavor of that, but it was a little more boring because it was stablecoins, which I guess is the point.
I did. I asked one of my partner's nieces, who's she's in her early 20s, if she or any of her sort of like university friends talk about or invest in crypto, and she gave me a pretty flat no. But you know, anecdotal data point does not generalize.
Well, and I will say, like young women seem to be a lot smarter than young men as it relates to all things fintech and financial services. So you might have gotten a different answer there, but good for her. Good for her.
But we digress. Genius was signed into law in July. So we do now have a piece of legislation that actually defines and eventually will regulate permitted payment stablecoin issuers. We've actually already had a couple of advance notices of proposed rulemaking that will begin to define some of the elements necessary to actually implement the law. The hot button topic that I still laugh that like the bank trades were asleep at the wheel or are just terrible at their jobs, that they're complaining about the so-called like interest or rewards loophole. So there's a possibility that there is some change or somehow that's addressed through some of the rulemaking processes to implement the Genius Act, although I'm not holding my breath. And seemingly every company ever now wants to have their own stablecoin for reasons, honestly, that are not entirely clear to me, whether it is core providers. So Fiserv notably announced that they're going to have a stablecoin. PayPal, I mean, this was, I think, actually last year or maybe 2 years ago, but PayPal has its own stablecoin, PYUSD. Klarna, for some reason, says it's developing its own stablecoin. SoFi. So really a dramatic explosion in industry interest and just in the sheer number. As you pointed out in the outline, and this is my favorite, Wyoming, the state of Wyoming launched its own stable token, not a coin, because I believe states are prohibited from doing their own coinage in the Constitution. So I guess if you just call it a token, that's a workaround.
Well, the framers of the Constitution didn't think to use the word token when describing money, but they should have.
Correct. There are a zillion different directions we could go with this. I mean, I guess given that you and I tend to focus more in like the banking and fintech realm, one of the common questions or common points of concern like traditional bank industry will point to is fear of deposit flight from the traditional banking system to this sort of parallel stablecoin system, particularly if this sort of rewards or interest loophole allows not the issuers, but third parties like exchanges or wallets to pay rewards. Do you have a developed point of view on whether or not you actually believe that that's a concern? Are you hearing from people in industry on either side that it is something that they see happening, that they're concerned about happening? Where do you see that going in 2026?
Yeah, I mean, a couple of things on it. So it's become like the sort of point of contention on the part of banks on the one side and then the crypto ecosystem on the other side. Obviously, the crypto ecosystem, I think, would prefer that there was no prohibition on yield at all relating to stablecoins. Banks were able to get a prohibition on stablecoin issuers offering yield directly. But as you pointed out, there's this loophole where it didn't restrict other parties that might be affiliated in some fashion with the stablecoin issuer from being able to pay yield to drive adoption, which functionally allows, yield-bearing payment stablecoins. My sense is that the crypto lobby is just too powerful and they got the ball too far forward for this to be something that gets retracted. If you watch like what Coinbase executives say on Twitter, which is I think a pretty good barometer for the lobbying conversations that are happening behind closed doors, I think they will do everything in their power to stop the lobbying change in any meaningful way and any like crypto market structure legislation or anything that might be coming down the road. So I think that we are going to end up with yield-bearing payment stablecoins. I think even if banks got what they wanted in terms of further restricting it in the Genius Act or in subsequent legislation amending the Genius Act, I think the reality is there's just no way to stop yield-bearing payment stablecoins. You think about lots of different use cases, right? Like imagine that the Disney Corporation has its own stablecoin that acts as a currency for anyone inside the parks, right? Well, Disney would have all kinds of levers to drive adoption of that stablecoin that might be reward-like in some fashion, right? Like early admittance to the parks, or a special pin that you get for your lanyard that only is available to you if you use the Disney USD payment stablecoin. Like, there are all kinds of ways that you can offer rewards to drive usage, kind of like under, what is it, Regulation Q that used to exist that restricted banks from paying interest above a certain level on savings accounts. They would give you a free toaster when you opened accounts, right? Like, there are ways to game these systems that go beyond just the actual yield that you're able to offer. Plus, the other thing with stablecoins is, even though they sort of function as kind of an equivalent to a deposit account, they are naturally out of the box compatible with the DeFi ecosystem, which then allows you to plug in any like DeFi yield protocols or other things. So functionally, there's a bunch of different ways to construct reward ecosystems for consumers around stablecoins, and there's just no way for regulators or banks to stop all of that. I think the larger question is, if stablecoins are able to offer yield, like, so what? Does that matter, right? And banks paint a very dire picture of what could happen in terms of, like, this will lead to deposit displacement. A bunch of deposits will leave. We will see, lending contract as a result because banks will have less deposits to lend, blah, 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 blah. And then on the other side, you can find crypto lobbyists who are finding their own, like, academics to create their own counter research papers that prove, no, in fact, this won't lead to any deposit displacement. This won't lead to any reduction in lending, blah, 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 blah. I tend to think, just sort of intuitively, that the deposit displacement won't be as great maybe as banks fear. And the reason for that largely is that, consumers are bad at maximizing yield, right? Like, and the fact that, stablecoins pay stuff isn't going to change that, right? Like, the fact that most people don't seek out higher yield, savings accounts, even though banks are unrestricted in their ability to pay as much as they want in yield on a savings account, that tells you something, right? Like, deposit betas at most banks are not 1-to-1. And what that means is, they have found ways to offer value or to capture inertia that, don't require them to pay market interest rates on their deposits. And I think the same dynamic will exist in stablecoins. The stablecoin issuers or stablecoin powered ecosystems that succeed long term will be those that find ways to build operating accounts or build real utility or capture pockets of inertia that won't be price sensitive. And the price sensitive stuff will naturally, like, compete itself down. And you've already seen this, like Coinbase, they used to offer a much higher interest rate on USDC held on their platform. And over time, they've lowered it. And you've joked about this on Twitter, and so have I. Like, oh, so we're, allowing for crypto companies to come in and give you all of the interest that banks were greedily keeping for themselves. No, like, this is just how the market works. That interest rate is going to get competed down, and the winners are going to be ones who find non-price sensitive consumers or businesses. That would be my theory long-term for how it plays out.
Yeah. Brian Armstrong, the CEO of Coinbase's Twitter account, literally raises my blood pressure to, like, a level that is just entirely unhealthy, because, like, the arguments that, and I guess I realize that, crypto is not a monolith. You have different camps with different points of view. But I kind of consider him like an avatar of, like, VC, sort of call it like corporate crypto. Like, the people who want crypto to become, available in every 401k, and have it basically become what I'll call like a synthetic bank account or bank account type replacement. And I guess, like, the arguments that I've seen him put forth on Twitter are just so incredibly disingenuous that it really does, like, make my blood boil. When it was coming, the debate around, like, the rewards loophole, and I think it was specifically Coinbase together with one of the crypto lobbying groups, like, describing it as a bailout for banks. And I was like, this doesn't even make any sense. Like, I understand from, like, a messaging and comms perspective, like, the public hates the idea of bailouts, but, like, anyone who understands what's happening here knows you're either a liar, an idiot, or both.
It's so disingenuous. I mean, it really is. No, it is. And the thing that's hard about it is, I've written about this before, but like the thing that's challenging about the stablecoin stuff is no one seems to be approaching the topic with any intellectual honesty at all, right? And this includes like, oh, you have an academic study on this thing? Well, we're going to go find a different academic who disagrees and they're going to write a research paper. Like everyone is just arguing for their own self-interest. And I think the banks are, complicit in this too. Like, I don't know how banks can argue that, like, on the one hand, if we allow these things to offer yield, all of the deposits will leave our institutions, while at the same time also arguing that, like, oh no, like we pass on interest to our customers. Like, you can't say that. Like, if you're concerned about interest, being the thing that pulls these customers away, well, then those customers should be easy to poach from someone, whether it's a crypto company or a fintech neobank or someone coming in and offering higher interest rates. Like, and if these customers are sticking around and they're staying with you despite the fact that you pay them low interest rates, well, then the only way that these crypto companies powered by stablecoins are going to take your customers is if they offer more utility or more value or better relationship banking or whatever it is you claim that keeps these customers with you despite paying low interest rates. And if you're concerned about them competing with you on that front, well, that's good competition for consumers and businesses because it means they're getting better products and services. So I really struggle with everyone's arguments on this. It seems just very dumb and very self-interested.
I think my last comment, or I guess maybe question, will be, when we check in on this at the end of 2026, how many of these sort of like corporate announced or corporate launched stablecoins do you think are going to still be around? Do we really need a Klarna USD, SoFi USD, PayPal USD? I understand if it's being used as, a quote unquote new rail, they're actually like that piece. I do see like incremental real utility and real value, but I cannot imagine a world where there are 200 consumer-facing stablecoins that are functionally all like undifferentiated. And to your point, in the US and in most developed Western economies, offer little to no utility versus a traditional bank deposit.
Yeah, it's a great point, right? I mean, I think that one of the things that'll be really interesting, there's kind of two parts to that question, right? One is how many different entities actually need to issue stablecoins. And I think we're already seeing a contraction on that front where it's like, oh, hey, the Genius Act passed. Anyone can be a regulated payment stablecoin issuer. You don't need, even though a lot of them have gotten national trust bank charters or trying to, you don't need to have a bank charter to do that. You can be regulated either at a federal level or a state level as a non-bank stablecoin issuer. Well, how many are actually going to do that, right? Like, is it worth doing the work for that? Or does that just sort of fragment the market and split liquidity across too many different stablecoins? And I think that's already sort of contracting. You're seeing a lot of, I think, interest or growth in the stablecoin as a service model, right? Which is like Stripe with Bridge allowing any company to issue its own stablecoin, but under the surface, it's all one stablecoin, or M0 or Paxos, which is the stablecoin issuer behind PayPal USD. So I think we're already seeing a contraction there because even people in the stablecoin ecosystem realize like we can't have a ton of stablecoin issuers. This is a winner take most kind of market where the parties that have the most relationships, the parties that have the most distribution, the parties that have the most liquidity are going to be the ones that sort of survive long term. But I think even to your front-facing, customer-facing point, the same question applies. Like, okay, we have stablecoin as a service providers. Does that really mean that like Klarna, who's working with Stripe to issue a Klarna stablecoin built on Stripe's infrastructure, like, does Klarna need its own stablecoin? Does that provide any value? I sort of poked at that question when Klarna announced they're working with Stripe on it. And the CEO of Klarna replied and went, well, we're not really doing anything today, but we think in the future we could be. And it's like, well, okay, maybe wait until those future things are real before like launching this. And so I think to your larger question, a lot of the announcements, whether it's we're actually going to issue our own stablecoin or we're going to use one of these stablecoin as a service issuers and sort of white label it. I think in both of those cases, most of these announcements are being driven by we want to tell are investors, either privately or public market investors, that were doing stablecoin something. It's not based on an actual like problem that's being solved. So I imagine we will see quite a bit of contraction on both fronts. So Jason, I think the like sort of inverse, the bizarro version of the stablecoin story in 2025 was open banking. Can we talk open banking for a second?
Yes, you're my open banking guru.
I wish I wasn't. It's I mean, I guess on the plus side, open banking will keep me employed for a long time, because it feels like I'm just destined to read comment letters and proposed rules and advance notice of proposed rules forever, eternally. But it is interesting to rewind the clock all the way back to 2024 and going into 2025, because I don't know if you remember this, Jason, we had a finalized rule and it was done. It had been done, I think, with a relative level of like good process. No one was totally happy with the final rule, which I think is sometimes a good mark of like everyone was kind of unhappy. So we might have gotten to some level of balance in terms of some of the policy issues.
That's how compromise works.
That's how I felt. Like everyone was kind of grumpy. And you will also recall, obviously, a lawsuit being filed shortly after the rule was finalized. In fact, I interviewed Director Chopra on stage at Money 2020 in 2024, and he joked that he hadn't read the lawsuit from the Bank Policy Institute, but that was okay because he didn't think they had read the rule either. And so lawsuit filed shortly after. I sort of thought of it, honestly, as kind of a pro forma sort of thing. Like, hey, they've published a rule we don't like. We're going to file a lawsuit, and then we'll see what happens. Interestingly, what happened, just to recap, and I'll do this very quickly, I promise, is that the lawsuit was filed in the district court in Kentucky, which was a strategic choice of venue by the Bank Policy Institute, and was put in front of a judge who, from what I can tell, is basically just sort of trying to do whatever the CFPB thinks should be done, which is not unreasonable. Now, it's not exactly how administrative law is supposed to work in the era of Loper-Bright, which we'll get to a little later. But fundamentally, the judge seems to just be like, look, you're the agency in charge of writing this rule. You tell me what you think we should do. And so initially, the plan was the CFPB basically said, well, we're actually going to join with BPI because we agree with them. And we think that the Biden administration, their CFPB overstepped their authority. We think the rule should get tossed out. We were on track for that to happen. And then, of course, JP Morgan Chase implements its aggressive pricing gambit. That causes a huge wave of outrage in the fintech and crypto ecosystem, which causes the CFPB to change its mind. The CFPB asks the judge to pause the case while they go through an accelerated rulemaking process, which, Jason, maybe even by the time this episode airs, we might actually have either a proposed rule or an interim final rule from this very, very understaffed CFPB, relying probably on ChatGPT, that will allow reportedly maybe data providers to charge fees, but may also loosen up certain restrictions like secondary data use restrictions in order to appease data recipients. I've written before about how the CFPB is kind of boxed in a bit in terms of what it can change without immediate and eternal legal challenges. Separately from all of this sort of CFPB flip-flopping, we have also seen significant developments in the private market. I referenced Chase implementing its pricing gambit. That gambit worked, and Chase has come to an agreement with several data aggregators to be paid for access to its data, most notably Plaid, which is the largest data aggregator by volume. And I think other such deals, both between JP Morgan Chase and other aggregators, as well as between aggregators and other large banks, are likely to happen regardless of what the CFPB says in its revised rule. And of course, all of this is happening with a very important backdrop, which is that open banking is working from a market perspective. I think probably the two most obvious areas where we're seeing significant growth in open banking adoption are in cash flow underwriting, which has really taken off over the last year. That's been a theme I've covered a lot. Banks are beginning to adopt it. The credit bureaus have leaned into it. FICO's leaned into it. So we're seeing significant adoption of open banking for cash flow underwriting. And I think we're also seeing quite a bit of it in fraud and fraud mitigation as well. Plaid has made a big bet in this area. I think by contrast, we will see the bank's moves in open banking, assuming that we don't see some dramatic reversal from the CFPB, really impacting certain other use cases like pay by bank, which had really also started to take off, I think, quite a bit outside of higher risk use cases like cannabis or gaming. We were actually seeing pay by bank starting to make more of a broad adoption in the market. Stripe had made a big bet on pay by bank. I feel like that's an area where, just from a margin perspective, what the banks are doing, again, absent the CFPB trying to protect pay by bank, we will see that either get hobbled or sort of functionally killed. But I don't know, man, like all of this is happening, and it feels like the regulatory drama is sort of becoming disconnected from the market reality. And the two in 2026 seem like they're just more likely to diverge further and further away from each other. What do you think about the open banking drama that we experienced?
Yeah, I mean, so as you and most listeners will know, I started my career in finance in the small dollar lending space, aka payday lending, and when I was working in that space, there was a lot of concern is not quite the right word, but there was a perception that the rule the CFPB was formulating at the time would dramatically reshape that industry. And that, for the record, was in like 2014. So literally a decade ago. And, some players, including the company I was working at the time, actively took steps to, change product structure, change business practices, to align with what the rule that was being formulated was going to do. And ultimately there were, endless lawsuits and challenges, and then the first Trump administration. And it made it very, very difficult to run and plan a business in a coherent way, because there was absolutely I realize there's no certainty in life ever, but the amount of uncertainty about what was going to happen, whether due to a change in political administration or as the result of a legal challenge, made it incredibly difficult to plan and run a business. And I do have, a lot of sympathy for the open banking aggregators, your Plaid, your MX, etc., and perhaps even more so the companies that sit downstream that are using that data or using that data / connectivity to power specific features or capabilities in their product, because it's really not clear what is going to happen other than the market is going to sort of sort this out. I know that, you and I have discussed previously, and the point that I, will continue to watch and be the most interested in is as contracts come up for renewal. So the companies that are using Plaid or using MX, as those agreements eventually get renegotiated, are there material changes to, what data they can get, what the pricing is, how they can use it, and how does that impact their businesses? And that will take, it will take time to flow through those contract renewals and renegotiations, and ultimately may end up reshaping the kinds of products and services consumers have access to. To your point, things like pay by bank, where, not that there aren't alternatives available, consumers are obviously very accustomed to using card payments. But like what we may not even see, consumers may not even see or detect what the actual results, what the consequences are of this sort of very disjointed and very difficult to predict operating environment are. And that's true across a whole host of regulations. You referenced, Loper Bright, or, living in this sort of post-Chevron plus corner post world. Yeah. And it creates an environment where essentially any company, any bank can file a legal challenge to any regulation at any time for any reason, and that becomes a much more challenging environment to try to build and operate a company in.
Yeah, no, it's exactly the right point. And I think that, one of the things I've been thinking a lot about is, okay, so in the absence of regulation being able to create some level of consistency, right? Because I feel like if we had just chilled out about the rule, no one was perfectly happy with it in the end of 2024, but I think everyone could have lived with it. And, even banks who were pissed about not getting paid for their data, the reality is with, Chase, and I've asked Chase about this, they're like, look, this isn't about us generating revenue. This is, we're the largest bank in the world. The revenue we're going to generate from open banking, it doesn't even show up on our balance sheet, really. It's pennies, it's fractions of pennies. It was more about exerting control over the ecosystem and shaping it in a way that, from Chase's perspective, is better for their customers and better for the ecosystem. From the perspective of fintech companies, is anti-competitive. You can sort of pick whatever side of that argument you want. But I think the reality is, it's not great for the ecosystem if the use cases that end up sort of being supported from an open banking perspective are picked by the most powerful players in the ecosystem, right? So you use Pay by Bank as the example. Chase hates Pay by Bank and would prefer that it went away because it makes their debit card business vulnerable, potentially picks a little bit of business away from their credit card business. They just don't want Pay by Bank to be a viable offering that exists in the market. The only company that could have really realistically pushed back effectively against Chase and made a real strong kind of case for Pay by Bank as a use case for open banking was Plaid, because Plaid has the most leverage in the market. But Plaid, for various historical reasons, never really had a huge business in Pay by Bank. It wasn't the hill they wanted to die on. And so the agreement that Plaid and Chase came to functionally, which I think is going to define a lot of the open banking market moving forward, regardless of what the CFPB does, that agreement kind of killed Pay by Bank from an economic perspective, because one party wanted to kill it and the other party didn't want to fight for it. Now, you look at someone like a Stripe, and Stripe has a Pay by Bank business, and Stripe cares much more about the Pay by Bank use case for open banking than it does, cash flow underwriting or fraud or other ones that Plaid or other data aggregators might care about. But, the question is Stripe going to die on this hill? Are they going to make this a priority? And my sense, I don't know, but my sense is they're all about stablecoins. They're all about other things. This is not the hill that they want to die on. And so it's just strange to end up with an ecosystem where the use cases that end up being supported and kind of become institutionally adopted across the entire industry are picked by the most powerful incumbents, rather than sort of picked more from a first principles perspective by regulators. So, to me, that's the thing that I find kind of disturbing about this. And even though I don't think this is going to stop open banking, we may not end up with the open banking ecosystem we deserve because of how things played out last year.
Yeah, I think it is discouraging, right? And it's also kind of, I suppose, thematically consistent with sort of how again, the United States or the current administration is approaching the United States' role in the world, right? It is the sort of the might makes right approach to business. And it's well, if in this case, Chase, or, let's use BPI as an avatar for just the largest banks, say, hey, we don't like Pay by Bank because it threatens our, very successful, very large, very profitable card businesses, credit card, debit card. And so we're going to use the market power we have to crush it. And sorry, that's the way it is. And ultimately, even setting aside the impact on, innovation and your Stripe and Plaid and whatnot, ultimately, it's always consumers who end up losing, right? One way or the other. They have fewer choices, and they have the choices that Chase and the Chases of the world want to make available to them. And there are reasons why Chase wants you to pay with a credit card and not pay by bank. And spoiler, it's not just the interchange. You're also obviously more likely to accrue debt that you're then going to pay interest on.
Yeah, no, it's exactly right. And I the last note on open banking is just that in the absence of regulation or regulatory certainty, the other way these ecosystems can evolve is through like standard setting organizations and sort of like industry cooperation. And that would be nice. And that would be needed actually for especially issues that even the regulation can't totally solve, like liability and third-party risk management, and some of these just very sticky wickets that are hard for even regulators with their legal authority to sort of sort out. But the problem is that depends on the goodwill of all the participants in the industry, recognizing that that's something that they should focus on and commit to doing. And my sense, just looking at FDX, which is the technical standard setting body for open banking in the US and potentially in Canada, which is leaping past us on open banking, which is going to be the subject of things I'll talk about in the future. That current status of FDX makes me nervous that we'll see any level of cooperation between banks and fintech companies at any point in the future. Like, I just don't see a level of like trust and cooperation, even for technical standard setting, which is like the easiest problem for a industry consortium or standard setting body to solve. Like, if they can't solve that, and they are still fighting with each other on technical standards, and they've made some progress, but like it's not perfect, and that organization is not what I would call super harmonious at the moment. I just don't know that like there'll be a level of like good feelings and trust necessary for progress on any other front to be made through industry action or industry standard setting. So in the absence of all of that, it should be a really fun to cover free for all in 2026. Jason, since we, have the time, can we do two more?
Let's do two more. But I'm going to let you do your favorite one.
Oh, God. All right. So I promise I won't make a meal out of this, but the headline for this trend, recapping 2025, is gambling is now our national culture. And I would lay the blame for this at a number of different feet, a number of different institutions. But if I had to pick just one, specifically for 2025, I would pick prediction markets. Because in 2025, prediction markets, which used to be this kind of novel and interesting sort of academic theory that had been sort of operationalized at a very small scale as a way to sort of add more truth into certain markets by creating financial incentives, prediction markets realized that there was a massive regulatory arbitrage opportunity available to them, thanks to the fact that the Commodities Futures Trading Commission, CFTC, basically was not going to regulate them under the Trump administration. And that allows prediction markets, which are ostensibly regulated by the CFTC, to list any event contract that they want, including sports. Most notably, Kalshi, one of the two largest prediction markets, 90+% of its volume in November of 2025 was due to sports. So these are sports betting apps functionally, without needing any sign off from their regulators or having to deal with state regulators at all. And the states are important here because, particularly for sports betting, that is a activity that is not regulated at a federal level. It is regulated on an individual state level, which is expensive and annoying, and gaming operators would prefer not to do that. So all you really need to do if you're a prediction market is build an app, add Donald Trump Jr. as a strategic advisor for your company, and self-certify your contracts with the CFTC. And then it's free game. You can do whatever you want. As a result, in 2025, the prediction market business boomed. Kalshi raised a $1 billion round at an $11 billion valuation, and Polymarket was reportedly planning to raise up to $2 billion at an $8 billion valuation. The traditional sports betting apps, FanDuel and DraftKings being the most prominent examples, have responded to this trend after initially saying, oh no, this is regulatory arbitrage. It's going to not be something that we want to look at because the loophole is going to get closed. They have decided to leap into it. They have actually broken off their relationships with the traditional sports betting and gambling trade associations in order to embrace prediction markets. They're both launching their own prediction market clones of themselves that are available in states that they would not ordinarily be allowed to operate in. And of course, Robinhood and Coinbase, my two least favorite fintech companies, have both also added in prediction markets, initially in partnership with Kalshi, but eventually it seems like they're going to go their own direction and build their own regulated exchanges in order to expand the pool of bets that they can legally offer. To their credit, somewhat, I guess, states and Native American tribes are suing to stop this. I don't want to call this completely altruistic on their behalf because many of them regulate sports betting within their own jurisdictions and collect tax revenue from this. So it's not exactly them doing this out of the goodness of their hearts, but still, they are trying to stop prediction markets from exploiting this loophole. It's unclear to me how much success they will have, especially given that the Trump administration is just deeply enmeshed in the prediction market industry. I joked before, but Donald Trump Jr. is actually a strategic advisor to both Kalshi and Polymarket, which I'm not sure how that works, but there you go. In short, Jason, I don't see any way that this doesn't become just so much worse in 2026.
I need to take a deep breath before I start and try not to go on some like insane rant. Again, I mean, similar to some of what I was saying in reference to Coinbase and crypto and stablecoin regulation earlier. It just some of the pieces about this that I tend, at least personally, to find the most irritating, apart from the just like pervasively negative influence on society in aggregate, and then particularly, individuals, especially when you integrate it inside something that is calling itself an investing app, which like Robinhood and Coinbase both do position themselves as investing, setting aside whether or not you want to consider invest Bitcoin or fart coin or whatever, like a proper investment versus something that's more speculative and gambling in nature. But then when you put something that I think any reasonable person would describe as just straight up gambling, particularly given that the volume is overwhelmingly sports events, and you're putting that, one line below, invest in this ETF, I think it flattens and equates these two things in a way that I think for, particularly for younger people who may not be as experienced in managing their personal finances or planning for their future, I think it is extremely like dangerous and pernicious at a aggregate level and at an individual level. As far as how some of the executives who run these companies, I'm forgetting the Kalshi guy's name, but Vlad Tenev, the Robinhood CEO, is like, he's like a cartoon villain in how he talks about this stuff on Twitter, which is why I delete it from my phone. Describing these things as, some sort of fantastic innovation that's a huge positive for society. I know there are other sort of industry commentators who've described these as sort of like information discovery. And it's like, if 90+% of the volume is people gambling on sports, I rarely curse. Like, that's just bullshit. Like, this is just gambling. This is a regulatory arbitrage so that you can launch a gambling app nationwide, ignoring any individual state regulation, ignoring any sort of like controls or common sense on who should have access and what context they should have access to it. I myself, like, I'm not a fan of gambling. You and I end up in Las Vegas way too many times a year.
We do.
And I can't say that apart from maybe putting, $10 in a slot machine once, I've essentially never gambled. I have no desire to do it. Plenty of people do. That's fine. But I do think there is a big difference between saying, I'm going to take a weekend trip to Vegas and go play craps, or go to the racetrack and bet on the ponies, versus I have a device in my pocket where UX designers and data scientists have meticulously A/B tested and optimized to extract as much money as possible from me to benefit their shareholders, which are overwhelmingly, wealthy VCs. I think calling these things innovation is just bullshit. It's regulatory arbitrage. And as you referenced earlier, prediction markets have been around for a long time, including primarily in academic use. The Iowa, I'm forgetting the exact name right now, but in the late 80s, functionally, when the Robinhood CEO was born, we're already using prediction markets in an academic context around presidential elections. So it's not that there is no possible, good use case, but the way that these are being deployed and monetized is gambling, and I find it disgusting and highly exploitative.
Yeah, I mean, I couldn't agree more. I think that, there's some great emerging academic research that basically looks at the point at which households give up on their financial dreams. And it's a really interesting moment, right? That's affected by a lot of different things, right? Like, for example, the cost of housing affects this, right? Because if the cost of housing goes up too much in the place that you live or want to live, you might determine earlier that there's no point in trying to save for a down payment, which, by the way, is a long-term savings goal, even when housing is more affordable. Like, it takes a long time to save up for a down payment. That requires a lot of financial planning and financial discipline. The moment you give up on that, what researchers have demonstrated is that you will then change your financial behavior accordingly, right? And not illogically. Like, if you've decided this thing is out of reach, well, then I'm going to do X, Y, and Z. And X, Y, and Z turn out to be, I'm actually going to work less hard and be less focused on my career, because why am I trying to earn more money or save more or whatever? Number two, I am going to spend more money. So buy now, pay later benefits from this. Credit card companies benefit this. I'm going to spend more. I might spend more money than I make, because, you only live once and who the fuck cares? And third, I'm going to buy more lottery tickets. And the lottery tickets might be literal lottery tickets. They might be crypto. They increasingly apparently are sports betting, which is positioned by some of these prediction markets as like, this is how I paid off my student loans. Like, they are positioned as ways to win a game that is otherwise unwinnable. And I bring all of this up only to say that, like, Kalshi, Polymarket, DraftKings, FanDuel, Crypto.com, Coinbase, Robinhood, like, these are companies who are financially incentivized, and you are seeing them do this in real time, to convince an entire generation of consumers to give up on their long-term financial aspirations. And the sooner they give up, the more money these companies make. And so, I mean, they traffic in financial nihilism in a way that I find deeply cynical and deeply dark and cartoonishly villainish, as you were saying before. And I don't see any signs of hope on the horizon, particularly from a regulatory front, given the Trump administration's, perspective on these issues. I just don't see anyone coming to save us anytime soon. And so I hope that the states are able to win some court cases. I hope that we're able to sort of beat this back a little bit. I mean, even letting the states regulate this, it wouldn't be great, but like, the states have like hotlines you can call if you feel like you're addicted to gambling. They have lists that you can get added to that opt you out either temporarily or lifetime from being able to touch any of these services or products or be marketed to them from. Like, they have infrastructure in place to help people deal with the problematic aspects of using these services. Prediction markets don't have any of that. And that's why everyone is piling into prediction markets, and it's dark and depressing.
I mean, one last depressing comment, and then we can move on. But I mean, some of the things that I've seen that they allow you to bet on are just disgusting. I mean, there was one category that was like, Israel is going to bomb Gaza today. Like, as a society, like, is this something that we want to encourage? gambling, speculating on whether or not one country is going to bomb the shit out of another country.
I ranted about this in a podcast we did a while ago where there was a bet, I think it was on Kalshi, that was, will Mark Zuckerberg get divorced this year? Like, what the hell? Like, why is that? That has no informational value. It has no value for like hedging in markets. It's just gambling that, by the way, has, to your point, a deeply corrosive effect on our culture. And it's like, what the hell?
All right, let's move on.
That was cheerful. All right, I don't know if this next topic is going to cheer us up that much, but it can't be as depressing. Give us your last observation from 2025.
All right, the IPO window has been thrown open. So after a bit of a false start, which at this point it's almost hard to remember that happened. There were a bunch of companies lined up to IPO. Trump had his Liberation Day tariff announcements. Markets kind of gyrated. I know that Klarna ended up sort of delaying, but ultimately did go forth with their IPO. So we've got Klarna, we got Chime, we got Circle, the stablecoin issuer, eToro, which is mostly crypto, but I think also does equity trading, Wealthfront, which is kind of an OG robo-advisor, Figure, which talks about itself as a blockchain company, but basically it's just a HELOC, and a handful of others. Companies saw like a pretty decent pop out of the gate. Honestly, I don't find even looking at or paying attention to that so-called pop out of the gate particularly helpful, given that it's literally a function of supply and demand of the float at the time of IPO. Given that a lot of shareholders have at least 6-month lockups, like I don't really see a lot of informational value in all the conversation around like, oh my God, Chime left X millions on the table because after it started trading, it jumped from X to Y. Like, my understanding is that that's generally really not how that works. But
Jason, you'd be a terrible CNBC reporter. Like, you're never going to get hired at CNBC with this attitude. IPO pops are what it's all about, man.
My dream of being on CNBC dashed. But I mean, I do think it is good and healthy to have some of these later stage companies actually debut and be traded on the public markets, as opposed to sort of the trend that we've seen of companies staying private much longer than they have historically. I mean, I know that, your Googles and Microsofts and Amazons, the sort of, at this point, 1 or 2 generations back, went public much earlier in their life cycle at much lower amounts. There are all sorts of reasons why. And we do not have time or the notes to discuss the reasons why. But I do think that going public and having the discipline of operating as public companies, as well as the information value to understand how public market investors value these companies is important and is quite helpful. I mean, I know that we love to see and discuss it's usually TechCrunch has some headline of like, private company X raised at a $10 quadrillion valuation. And honestly, I usually just ignore that information, because without understanding the kind of structure that went into those private company fundraisers, I don't really think it's particularly meaningful. Whereas at least, I mean, yes, there are some distortions in public markets driven by, somewhat, some could argue irrational retail trading behavior. So stocks like, Palantir or Tesla, where you look at the fundamentals and then you look at sort of what they're trading at and you're like, this makes no sense, but like clearly some investors believe it.
Well, SoFi has an element of that in fintech too, right? Like there are fintech and bank public companies that are more fundamentally driven and more ones that have retail interest. But I think like over the long term, the public markets act as kind of a governor on any of that sort of speculative behavior, because it's just not sustainable. Whereas I'm with you on the private market thing. Like, I don't know what to make of some of these very, very late stage, it seems, I mean, I'll pick on Ramp as the example, even though I think they have built a great product, but like they seemingly, raise hundreds of millions of dollars every like 3 months at an up round every single time. And it's like, what is happening? Like who who's selling shares, who's buying shares. What is this sort of like endless appetite that private market investors have for certain companies? And I think you could lump Stripe into this category. I think Plaid is an interesting sort of like edge case, maybe example of one that like, will they have to go public in 2026? Will they not? But to your point, there does seem to be, for a small number of usually sort of very tech-oriented late-stage private companies, this sort of ability to ignore the laws of gravity. And I can understand if you're the CEO of a company like that, like going public is annoying, right? Like it restricts what you have to do. You're more responsive to shareholders on a quarter by quarter basis. Maybe you think it'll like slow down your ability to like ship products or like move as fast as you want, which is like a very strong cultural element inside a lot of these companies. Like I get it. Like why would you want to go public if you don't have to? But I also think, I mean, this is a strange analogy, but it reminds me a little bit of the way that like TV and movie creators talk a little bit about like Netflix versus like traditional, movie studios or television studios, where it's like back in the day, if you were making a television show, it had to fit within a very specific half-hour format. There were 3 commercial breaks. You were expected to do, 30 episodes per season. Like there was a structure, and the structure was annoying, and it didn't work well for every show that you wanted to create, whatever. But the structure also forced you to be good within that structure. There was a discipline to it that was nice. And I've actually heard some like writers and directors and producers of television who've sort of bemoaned like the Netflix effect of, here, just take a bunch of money. We'll never ask you any questions. We will never tell you how many episodes you have to create. We'll give you no structure at all. And we end up with these like really self-indulgent, mini series where it's 4 episodes, but each episode is like 3.5 hours long. And it's like sometimes you need an editor, sometimes you need structure, sometimes you need discipline. And I feel like the public markets, in addition to giving you and I good data that we can react to and actually trust, I think it also puts a certain level of discipline on the way that these companies operate. And I feel like that's missing to a degree with some of these companies. And I'm a fan of public markets, I guess is the long and short of it. And I wonder which companies we will see in 2026 embrace the challenge, but maybe also the benefit of being public versus staying private.
Time will tell. Should we wrap it up? Well, almost wrap it up with some predictions for 2026?
Let's do. And so I think what we should do is I asked each of us to come up with 3 predictions. Although you might have a bonus 4th prediction, which is fine. And I think what we should do is we should take turns offering our predictions for 2026. And Jason, I will let you go first. We'll just swap them one for one. So you go first.
Okay. I do think that we're going to see some kind of financial or banking crisis. Maybe it's in 2026, maybe it's not, although it really feels like the velocity is increasing at like an exponential rate right now.
It does.
I mean, when you see these trends of rapid, I guess I'll say rapid innovation, rapid change, coupled with what I would characterize as quite extreme deregulation, it does tend to lead to things breaking. Now, what is going to break? What is going to light the fuse of some kind of either recession and or banking financial crisis? It's hard to say, right? Like the topics that are top of mind. I mean, everyone obviously is talking about AI bubble. I have, I won't say that I've dug deep into like the financials beyond sort of reading, the mainstream business press as far as the highly circular and interwoven nature of some of the investments in that AI space that just feel like wildly unsustainable.
Well, a lot of them are debt driven more than they used to be, right?
Yes.
Like the financing used to be the companies themselves. Yeah. And now they're moving it off their balance sheet.
Yeah, those two pieces are very Enron vibes, right? We're going to spin up an SPV, have it take on a bunch of debt that we're hiding off our balance sheet. May or may not actually have a path to like monetization where there's like a true return on the money being invested. Our friend and colleague Kia has written a lot about credit. I know you and I have discussed like private credit. There's like a opacity there, I guess, similar to the nature of private market companies, where it's like it's hard to tell exactly what's happening because it's sort of behind closed doors. And stable coins. I guess this will be we'll call it my second prediction. Like there will be a stable coin failure at some point, and exactly what that looks like and how it unfolds and whether or not there are spillover effects or contagion into other parts of the crypto or traditional banking ecosystem is probably highly dependent on like the size. But I mean, imagine, something with Tether, everyone's favorite company to sort of speculate about because it is bizarre and mysterious. There will be a stablecoin failure at some point, and how that is handled, perhaps it is benign and relatively self-contained. Perhaps it's not. I took two, so now you go.
No, that's fair. That's fair. And your two predictions, just to comment on them real fast, because they actually tie into my first prediction. I think you're right, and I think that the thing that's challenging about the opacity of private markets, private credit, all that like off-balance sheet stuff that's happening is you just don't really have a sense of like where the problem actually sits, right? It reminds me of like dark matter, where it's like astrophysicists are like, yeah, 97% of the universe is dark matter. And you're like, cool, what is that? And they're like, we don't know. And it's like, okay, great. So we don't know anything about what most of the universe is. Awesome. And I feel like that is kind of equivalent to private credit in particular, where it's like we're starting to see some signs of fraud and some signs of stress in certain private credit examples. I think Jamie Dimon has referred to them as cockroaches, and there'll be more cockroaches that come out. The flip side to it, though, that's interesting is like banks have kind of like gotten themselves away from this part of the market, right? Because of capital requirements. Like they're not allowed to do these deals, at least the way they used to do them. Now, as has been reported by Bloomberg and a bunch of other publications, banks are actually now investing in private credit funds or lending money to private credit funds in order for them to lend money out, which sort of moves them up the stack in terms of getting repaid. And so I think less of this risk sits inside the banking perimeter, which is, I guess, good. But it's not clear to me like where the risk now sits. And just to give one example, a lot of private credit is funded by like life insurance companies, right? Because they have these long duration premiums that are going to get paid out in this very predictable like cash flow. Are we going to see like a large life insurance company go bankrupt? Like, I just don't know where the liability or the risk sits, but it has to sit somewhere. The money's coming from somewhere, and I just don't have a good sense of that. And that, to your large point, makes me nervous. I will say, related to the stablecoin issue or bankruptcy fraud point, the other thing that makes me nervous about all of this is that when you push this stuff outside the banking perimeter, all of the mechanisms that we've built and pressure tested for decades on how to handle failure don't necessarily matter or work, right? So like, it's great that the Genius Act took a stab at making stablecoin issuers, reserves, bankruptcy remote, and all of these things. But like, when a bank fails, the FDIC has a very well-practiced process for resolving that failure and making sure essentially that like funds are available Monday morning and that the bank fails over the weekend and everything is taken care of. It's not just that the assets are bankruptcy remote, it's that there's all these other mechanisms to help with the resolution of the failure. None of that exists for stablecoins, right? And so like when a stablecoin issuer inevitably fails, which will happen to your point, there's just not any of that like infrastructure that's been pressure tested and is available. And I know regulators are working on building out like the regulatory apparatus to support the Genius Act, but we haven't tested any of that yet. And so doing like live fire drills in 2026 with stablecoin failures makes me a little bit nervous. I will just add to those two predictions my sort of related prediction. And it was funny when we were filling out the notes for today's show, because I noticed you filling in the same notes I was filling in for this section at the same time. And we were both like, something bad's going to happen. Something's going to fail. So it's kind of dark as we were doing it in parallel. But I think that if 2025 gave you 2021 vibes, which it definitely did for me, then if you follow that analogy, 2026 will be something akin to 2022. And the end of 2022 is when FTX failed, right? And so like I think just tracking on like history repeating itself very, very quickly, I think we are going to see something break in a pretty dramatic way in 2026. And I don't know where it will be exactly, and I don't know how big it will be. Hopefully, it won't be something that impacts sort of ordinary consumers quite as much as we saw in 2022. But I don't know what that's going to look like. And I guess the thing I worry about, Jason, is how will regulators react to that? Can we trust that they will react in the appropriate way? I guess you could argue that the Biden administration went overboard in its reaction to the failures we saw in 2022, but they didn't underreact. And I worry that we might underreact a bit in 2026.
Yeah, I mean, this, I recall making some predictions when Biden was initially elected, and they were all 100% wrong.
Totally.
It did feel like that administration really tried to sort of freeze things in time, and so I am pleased, and I know we didn't get to a full conversation about the de novos. Like, I am pleased to see some kind of like forward momentum. That said, I think we're getting that forward momentum without the brakes or guardrails. And so I think it is a when, not an if something goes wrong or something blows up. I think it's a question of like, will there be the necessary skills, expertise, systems, resources to address whatever that blow up is? I guess my two, and these are much more specific and less thematic predictions, I'm hoping we see the final chapter on Synapse Evolve in 2026. What that final chapter is, I will refrain from speculating on. And last but not least, I think that Vero either fails or gets acquired on the cheap.
Ooh, that's a good one.
They've been running on fumes for a long time, and we'll see how much farther they can go before somebody acquires them, or it gets sort of wound down in some way.
Those are good ones. I will leave the speculation off on the Synapse Evolve stuff, though. Hopefully we get some type of resolution and maybe some information. We'll see. The Varo one, I think, is a great call because there's an end to all things, and it feels like that is nigh. My last two predictions. One, I don't think that we will see consumer credit crack in a meaningful way in 2026, absent like a very severe economic recession. And I talked about this actually on the Bank Nerd Corner podcast as well with Kia, but I just think like, commercial credit is different because it's a little more subject to like kind of the qualitative risk assessment type stuff and fraud and private credit and stuff we were talking about before. But I think on the consumer credit side, even though debt levels are up, I think a lot of that debt is either in the hands of pretty experienced lenders like credit card issuers, or is being done through new product structures like BNPL and earned wage access. But those are like fairly structurally safe from a credit risk perspective. Like, not to say that those companies doing that underwriting are doing a great job, but none of the loans are that big, nor are they that like long term. So I just don't see like a big time bomb out there waiting in the consumer credit space to blow up. And then my second prediction, which I guess is my last prediction, my third one, is I kind of think, going off of your Synapse Evolve thing, I think we might see a shift in banking as a service towards stablecoins kind of becoming the preferred infrastructure for developers who are wanting to build fintech things. And we've already seen a bunch of like stablecoin based neobanks pop up, some of which are amusingly aggressive and bad as it relates to compliance and just, building stuff the right way, which is what happens when you build on permissionless infrastructure versus working with a bank partner. And again, it kind of returns to this larger macro theme, which is like, I know constraints are annoying to people, but constraints help you build stuff the right way. And, if you avoid the public markets, or, you avoid getting bank partners and you just build on permissionless infrastructure, like, it's easier, but you might build the wrong thing, or you might build something badly. And I feel like developers are really going to be pulled towards the Stripe-like infrastructure that's being built by Stripe and others on top of stablecoin rails. And that makes me maybe a little nervous about the future, and maybe also contributes to my something's going to break in 2026 prediction.
That, I think, is the perfect segue to your Can't Let It Go, if you want to...
I do. It is the perfect segue, as a matter of fact, because there is a stablecoin crypto based neobank called Contigo. I would sort of think of it in my own head as like the unhinged crypto neobank. And I say that because the CEO had an incredible tweet sort of publicly launching the company. The tweet at various points said, "Jamie Dimon, we're coming for you." It also said, "Disclaimer, Contigo is not a bank. Banking services are provided by the freaking blockchain," which, Jason, is a quote that I'm going to write down somewhere on like a whiteboard that I can keep just up in my office for the foreseeable future, because that may define 2026 and beyond in a pretty significant way. That tweet also included a video of the founders sort of making the trek from South America, where they're based, to New York to take on New York. The video starts with one of the founders being shirtless in their office, which has sort of like kind of a WWE sort of Jamie Dimon, I challenge you to a wrestling match kind of vibe to it. The company came out of Y Combinator and has raised, let me check my notes, a $20 million seed round already. And I won't go into this because this is a subject for future discussion and possibly reporting by you, but it has also gotten itself into all kinds of compliance problems, which we will cover on a future episode. Suffice it to say, incredible stuff, and is providing a lot of fodder for Twitter entertainment, if nothing else.
Yeah, I saw also, I think it was a separate video where the founder or the team was talking about how they rented a $23 million mansion to lock in while they're building the world's biggest bank. And I cannot even describe the number of red flags associated with this company. But yes, I'm sure
it's incredible. It's incredible. They're like grabbing the red flags and like trying to like stab Jamie Dimon with it. It's amazing. It's amazing.
I'm sure it's not the last we've heard on that one. I will keep mine very brief to close out our episode. As I mentioned at the top, I'm here with my partner's family in Arizona. Watching a lot of different things on YouTube, as one does. And he has two younger nieces. So that, I think, is calibrating the algorithm, including the ads. And I noticed multiple ads for various sports betting apps, and specifically targeting women, which, I mean, on the one hand, like, makes sense, whatever. I come from a marketing background, you segment your potential audience and tailor the creative accordingly. But it really reinforced to me the rock bottom of the barrel we're at when we're creating, bloggers who are on sort of like a podcasting set talking about like how great whatever what DraftKings or FanDuel or Polymarket, and specifically trying to entice younger women about how fantastic these services are. Yep. That's where we are.
Oh man, it is exactly where we are. It is where we are going. It will be equal parts interesting, entertaining, and infuriating. And Jason, I look forward to talking about it all with you over the next year. Thank you for carving out some time today, a little extra time for a long episode. And I look forward to connecting again in the future. Have a happy new year.
You too. Until then.
Thank you, sir. All right.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.